Hello FX traders, this is FX with Q. Today's Monday, June the 4th. In this video we're going to be talking about the Australian dollar. So far earlier this week we've already seen a pretty positive move from the Australian dollar, and here we're looking at a composite index equally weighted of the Aussie versus the majors. This move is actually a reaction to data that was released a few hours ago, Sunday night, and it was overwhelmingly positive corporate profit data, coupled with a retail beat as well, 0.4% coming in versus a predicted 0.3. From a fundamental standpoint, the setup poses an interesting question because there is a principle in trading that's often cited by retail traders that's buy the rumor, sell the news. And the Aussie dollar actually is poised for, it could be a substantial move very soon with the release tomorrow of the RBA's rate statement, and that's coming in at 5:30 GMT, which is 12:30 a.m. Eastern Standard Time. And the other big release, which is actually slated to be positive as well, is the GDP release. It's coming in at 12:30 a.m. Greenwich time, and that's going to be 9:30 p.m. for traders on the East Coast. I mentioned buy the rumor, sell the news because oftentimes what you'll see with the news trading setup is for the asset or currency to be bid before in the lead up to data being released, and then after the release, after the period of initial volatility, the gains in the lead up are then faded. The way the buy the rumor, sell the news process works philosophically is that after holding onto an asset during a period of buildup, positive anticipation usually, upon the confirmation of the positive data being released, what many traders will do is sell to those who are rushing in response to the positive data, and that's a way of creating more of a sure win on a trade for those who choose to play the market that way. Taking a look at the scenario behind the RBA rate decision, we can look back at May's RBA rate decision. What happened was that the Aussie made some ground against the dollar due to the decision by the RBA to leave its cash rate unchanged at 1.5%, which was actually expected. Now, the fact that the Bank of Australia is choosing to reiterate that their status quo is consistent with meeting the growth needs of their economy and the inflation targets is significant because that's the expected outcome for tomorrow's decision as well. I do not believe that we're going to see the cross, particularly Aussie dollar, react as strongly as in May. However, a positive GDP data beat would be something that has the potential to move this cross, in my opinion. And that's because the Aussie has been a bit of a unfortunate bystander to the U.S.-China trade tensions. Before we look at the technical setups for the different Aussie crosses, I would just like to point out that my overall enthusiasm for trading these setups this week is slightly less. It's about a 7 out of 10. Very fortunate run over the last few weeks. I really have been trying something new with my manual trading, and combining fundamental themes, combining attempts at gaining the edge through fundamental insights with technical patterns over what most people would call a medium time frame, and this has worked out for me really well over the past few weeks. And I have been actively in the market, fully committed to positions from a leverage standpoint for the past 7 or 8 weeks. So it would be okay for me to sit out this week if the situation with the Aussie just doesn't present itself to my liking. So in looking at the technicals for the crosses, we're going to start with the Aussie dollar. And here you have an advanced harmonic pattern, a butterfly. There's a rather deep swath that's cut from the A to B leg of the pattern, and that's because the B to X retracement is 0.78, so it goes almost 80% the way through the range before coming back up. I do feel this pattern does meet the criteria that I choose to follow for harmonic patterns, and I would think that this is an acceptable pattern for to warrant an entry. But I am going to look for those fundamentals to resolve themselves before I build into my position much more than I already have. As for the next area of resistance that I'm eyeing, it's the 382 level on the C to D retracement, and that's going to line up pretty well with some area of consolidation at 76.8, 76.88, 76.90, and so we're going to look for some resistance. And if you go to the weekly chart, there has yet to be a bullish cross on my preferred oscillator. And what happens when oscillators start to meet up is that when the quicker line and the slower line of the oscillator meets up, you do have a bit of you have a chance for traders to note this resistance, particularly if you keep your parameters more or less set to widely used or widely watched levels. So essentially the equivalent of a 200-day moving average. It's a standard fare for technical traders and people who watch the markets on a technical standpoint. Moving on to the pound Aussie. This is actually a bat pattern that's already been followed through. The break is actually, the retracement is followed through quite well here. And for this pattern, I've chosen to draw my Fibonacci levels from the overall X to A move of the entire pattern. And the reason why is that I feel that the retracement that we're looking on right now, so the move past point D, there was a bit of consolidation at the 382 level, which is at 175 or 176. And so what we're going to see if the Aussie does get bid is we're going to see a move further down to resistance at 171, to resistance at this 236 level, 169, which corresponds to the highs back in September of last year. As somebody who's been watching the market and trading the market with respect to these harmonic chart patterns for quite a while, it is significant that the price has broken through the level at point B, which is 1764. That's usually the time when you will see a pullback of retracement, and that the C to D leg of most of these patterns represents a commitment from either the bears or the bulls, and once the price gets to the midpoint of these patterns, those levels are often respected, and they're certainly not taken lightly by many traders. Moving quickly back to fundamentals, talking about the pound. After a fairly weak week of data releases for the UK macroeconomic measures. We have a return of Brexit fear because lawmakers are now back in session in Parliament from their recess, and Prime Minister Theresa May and the rest of Parliament, they're going to be looking very closely at measures regarding a deal with the EU. And if the deal with the EU fails to become a reality, there are a few adverse scenarios that have been proposed. And in the most severe one, there are shortages of food, shortages of medicine and fuel, particularly strain on transportation. The port of Dover has been mentioned as a, just because of the logistics of checking the trucks as they board onto ferry transport. There's a lot of unforeseen problems that are starting to pop up if the EU and Britain cannot forge ahead and make a deal. Then they're going to need to have lots of quick solutions, lots of creative interventions to deal with these adverse scenarios. Looking at the Euro Aussie, there's a 3 drives pattern, which is fairly loose. It's not a perfect symmetrical 3 drives pattern, but it's one that I've identified and I choose to characterize the bull move from early 2017. Now, this retracement off this pattern has been very consistent. So we have 7 weeks of euro decline, and this is actually largely due to euro weakness over the past few weeks. The situation in Italy and Spain and the solidity of particularly Italian bonds. As a result, from where I stand, there is the chance that this pair could be just simply oversold in the short term. And I'm not going to be looking for the Aussie to be gaining too much more ground against the euro, despite the potential for positive fundamentals. Aussie yen presents itself as another interesting case from a technical perspective due to this butterfly pattern here. Now, from a fundamental perspective, it's fairly convoluted, and that's due to the yen's basis as a currency that responds to the risk theme. So the risk is tied primarily with asset allocation. And the United States economy has had the most substantial recovery since the Great Financial Crisis, and this bull market that we've been in for quite a extended amount of time is now in a period of, or has been in a period of consolidation, and it's a wedge pattern. I don't really like to trade wedge patterns, but that does indicate the potential for a substantial breakout in either direction, bullish or bearish. And finally, the last pair that I like to talk about, the Aussie CAD, is interesting because of the two currencies, the two countries' similarities. There's similar economic situations, collectively known as they're part of the collective as known as the COM dolls, the currencies which are influenced by movement in commodity markets. But there is still extremely substantial potential for divergence on a fundamental basis, and that's due to the relationship of either country with the United States. All one needs to do is to scroll down the U.S. President Trump's Twitter feed to see that there is often a barrage of developments regarding NAFTA, which affects Canadian currency quite heavily. And the recent CAD weakness that you can see on this chart has been due in large part to developments that have happened, lists of tariffs, lists of of actual tariff levels which have been proposed by both trading partners, the United States and Canada. That the cross has moved towards the midpoint of the range, to me, is actually significant. I do not feel that getting in right now is a good idea. The midpoint of ranges there a chance for retracements to happen. There are a chance for a reversal of trends to happen. So that concludes this week's trading video about the Aussie dollar. I hope you follow my trades on Twitter. I'll keep you guys updated there, and good luck trading this week.